So you found that next killer stock and you're ready to pull the trigger. Whether you've done your extensive research or you heard a rumor at the water cooler, you're ready to hop on board. But wait, what if I told you that you can buy that stock at a discount? You can buy that stock for less than what it's currently trading for today. Well, it's true. Yes, it is indeed possible, and I will show you how in today's video. Hi, I'm Andrew, and I've been studying the financial markets for all of my adult life, and through these studies, I have determined that options trading is by far the best way to put the odds in your favor and give you consistent income. And just to prove how possible it is, I release weekly videos to document my trades, showing my profits and losses so that you can see that it is indeed possible to earn consistent income from options trading. And I started this YouTube channel to share my knowledge about options trading for anybody who wants to learn. My goal is to bring you better options. In today's video, I will show you how you can use options to buy stock at a discount. Why pay full price when you can buy for less? This strategy can revolutionize how you buy stocks in the future. Now, before you continue watching this video, if you're not sure what options are or how they work, then I highly recommend that you watch the Demystifying Options video first. It will give you a foundational explanation of what options are to give you a better understanding of the concepts that I'll be covering in today's video. Now, before I get into how this strategy works, let me cover one very important rule that you should use when implementing this strategy. That rule is to only use this strategy on stocks that you want to own. If you wouldn't be happy having that stock in your portfolio, then do not use this strategy for that stock. So how do we buy stock that we already want to own at a discount? Well, the answer is surprisingly simple. All we have to do is sell a put. Yep, that's it. Just sell a put. Now wait, video's not over. Let me go into some more detail about how we utilize this strategy. This strategy is so simple yet so effective. I think it's a great way to get started with options trading. If you're overwhelmed about all of the different strategies out there, such as iron condors, calendars, straddles, strangles, ratio spreads, and jade lizards, just forget about all of those for now and just start selling puts. Doing so will help you get familiar with the process and help you get familiar with your trading platform. And then once you start getting the basics down, then you can start looking at some of the more advanced strategies. So let's go ahead and hop on to the trading platform to show you how this works. All right, so here is my trading platform of choice. It is tastytrade. I've been using it for many years and I'm very accustomed to its layout and its functionality. So it's my go-to platform. But if you are, as many of you might be, new to options trading, I'm going to take just a couple of minutes here to give you a basic overview of the platform, just so that you can follow along with what I'm going to cover in this video. So let me collapse this here. And what we're looking at is, as you can see in the top left corner, there's a little window here to enter the ticker symbol for the stock or trading instrument, underlying instrument, for which you want to see an options chain. So this is on NVIDIA. If I wanted to change it to Tesla, I can just type in the Tesla ticker symbol and then I would see the option chains for Tesla. But I'm going to go back to NVIDIA. If I can get it entered, there we go. All right, so there is NVIDIA. And then across the top here, you have the IV rank, which is one of the key components for option pricing. If you watched my Demystifying Options video, I talked a little bit about the Black-Scholes model, which is the model used to assign pricing to all of the options that are traded. And IV is a major component within that pricing model. Also along the top here is the last trading price for the stock, and you can see as of the close of the market on Friday, it closed at $129.84. So rounded up to about $130 per share. And then you can also see the change on the day, the percentage change on the day, the bid and the ask for the spread between the asking price and the selling price. So this main section in the middle is what we call the option chain. And down the left side, you can see all of the expirations for all of the different cycles. Now, options can be traded in a few different cycles. There are 0 DTEs, which mean they open up on the same day that they expire. We don't have those on this stock, and I don't trade them anyway currently, so it's definitely beyond the scope of this video. But this stock has both weekly cycles and monthly cycles. The way you can tell the difference is that the weekly cycle has a W, and the text for the date is not as bright. And then the brighter text without the W is the monthly cycle. So we can see 1, 2, 3, 4, 5 weekly cycle option chains. And then we can see several more monthly option chains. And I will tell you that monthly options are more popular than weekly options. So essentially what that means is that there's more activity, more volume on the monthly options than there are the weekly options. And that can be an advantage because there's more liquidity in those option chains. And by the way, all of these dates are on a Friday. Weekly options obviously expire every week, whereas these dates here, you will see if you looked on the calendar, are all on the third Friday of the month. So it's pretty important to be aware of when your options are expiring. That's something that you definitely want to stay on top of. So another handy little feature that the trading platform provides is the number of days until expiration, so that you can be aware every time you come into the platform, you can look at your position and you can see the number of days that you have until expiration. Now, as you know, if you watched my demystifying options video, I do not buy options typically. I make most of my income by selling options, and when we sell options, we are looking to collect premium and watch that premium decay from the option pricing over time, which is called theta, taking advantage of that theta decay. And when it comes to selling monthly options, studies have shown that in order to collect the greatest amount of theta within the shortest amount of time, we want to sell options that are anywhere from 30 to 60 days in duration. So if we look at these option chains, we can easily find the option chain that is 30 to 60 days of duration. So if we're looking just at the monthly expiration cycles, the first one we have is 12 days, the second one we have is 40 days, and then the third one we have is 67 days. So that's a little too long, that's a little too short, this one's just right. So let's go ahead and expand this option chain. And now I will explain what we're looking at here. Don't let it overwhelm you. It's actually pretty simple once you get used to it. So remember, with options we have both calls and puts, and you can see this screen is divided into two sections. The left side is calls and the right side are the puts. And then down the middle, these are the strike prices. Now if you look at this brown line that's going across the middle of the screen, that brown line indicates where the current trading price for the stock is. And as we can see here, it's just under $130 a share. And so the brown line is between 130 and 128, which corresponds to the current trading price. Also on that brown line, you will see a very tiny ITM on this side with an arrow pointing up, and a very tiny ITM on this side with an arrow pointing down. And again, if you watched my video on demystifying options, you understand what ITM means. It's in the money. So this indicates that all of these options on this quadrant of the screen are in the money, and all of these options in this quadrant of the screen are in the money. So these are for calls, these are for puts, and then these two quadrants are out of the money. Out of the money puts, out of the money calls. So now the first two columns on each side is where you will find the current price for each option. You have the bid and you have the ask for the calls, and you have the bid and you have the ask for the puts. So if I wanted to know how much it would cost to buy a put with a $120 strike price, I would come to this row, come over to the buy column, and right there indicates how much I would have to pay to buy a put with a 120 strike price. So let's take this back to the definition of an option, and let's illustrate each part of that definition by what we're looking at on the screen. So if you recall, an option gives the buyer the right, but not the obligation, to either buy stock if it's a call, or sell stock if it's a put, at a specified price, which is the strike price. So that would be these numbers down here. So let's just say a call for illustration purposes. So a call option gives the call owner the right to buy the stock at one of these prices on or before a specified date, which would be this date right here, and that's the expiration date. So for illustration purposes, if I bought the 135 call, it would cost me $8.80, and that would give me the right to buy NVIDIA at $135 a share by March 21st, 2025. And if you're not sure why anybody would want to buy this call, go back and watch the demystifying options video where I explain why somebody would want to do that. So let's say you've been watching NVIDIA and you've just kind of gotten tired of watching it go up day after day after day, and you decide, okay, I want to be in the stock, I want to buy this stock. So here is the stock chart for NVIDIA, and you can see as of the time that I grabbed this screenshot, it was trading right about $130 per share. So the first thing we need to do is to decide how much do we want to pay for this stock. We don't necessarily have to pay $130 per share, and if we're patient, we can definitely pay less than that, because as you can see here, stocks tend to go up in a secular fashion or in a stair-step type of fashion. They don't go straight up. So let's say we decide we're comfortable buying this stock at a price of $125 per share. So then we can switch over to our option trading platform. We can find the $125 strike price, and then we can see how much the put options are selling at that strike price. And we can see here it's right about $8 per contract, and remember, one contract controls 100 shares. So just for the ease of illustration, we'll go ahead and say that one contract is selling for $8. All right, so let's go ahead and compare the scenario here. We'll say that you are the put seller and you're selling the put for $800, which is the 125 strike put. And we're going to compare your performance to that of a stock investor who is buying the stock, buying 100 shares of stock, because remember, these options control 100 shares. So to make it an even comparison, we have to compare to someone who is buying 100 shares. This stock investor on day 0 buys 100 shares of stock at $130 per share, while you sell one put for $800 credit. So let's fast forward to day 20. And on day 20, we can see that the stock has gone up a little. It's gone up to $132 per share. The cost basis for the stock investor is $130 per share, so he's looking at a $200 unrealized profit. On the other hand, you sold the $125 put Theta decay has gone by and has now allowed you to close out that put for a 50% profit. So you go ahead and do so. You buy back the put for a 50% profit, which means you book a profit of $400. And at the same time, once that closes out, you open another position by selling another put for another $800 credit. Now, you might be asking or might be wondering, why are we selling at a 50% profit here, or why are we closing out the position at a 50% profit? And let me explain why. That's what I call juicing the option. So let's take a look at an example. If you sold the put back here on this date, and the expiration for this contract was out here, in order for you to take all 100% out of the option, you would have to wait this entire time. But what if you could close out for a 50% profit here, and then close out for another 50% profit here, and then another 50% profit here, and then once again here? If you were able to do that, you now have just booked 200% profit rather than 100% profit, and that is actually very feasible because of the cyclical nature of stocks, in addition to some other pricing components of options. It is actually quite feasible to take 50% profits throughout the duration of that particular option contract. So that's why I always close out at a 50% profit, and then I will reevaluate where I want to sell the next put. Maybe I want to move the strike price up or down a little bit depending on where the stock price is, and I will open a new position. So let's go ahead and go back to our scenario. All right, so again, you have already booked a 400% profit, and the stock investor is sitting with a $200 unrealized profit. So we go ahead another 20 days, and the stock price has come back down to $130 per share. The stock investor is now sitting at a zero profit or loss. He's not losing money, but he's not gaining money. You, on the other hand, had more time decay, so you were able to close out for another 50% profit, which means your total profit is $800, and now you're able to sell another put for another $800 credit. And let's go forward 20 more days. Now we're at the 60-day mark where the stock drops down to $124 per share. Unfortunately, the stock investor is now sitting at a $600 loss. But let's take a look at your situation. We'll assume that we're at expiration at this point, in which case you will have to buy the stock at $125 per share when the stock is only worth $124 per share. So you're actually paying more for the stock than it's actually worth, fair market value. But you've collected $1,600 in credit along the way, and you get to keep 100% of the premium that you collected on the most recent put option. So you've collected a total of $1,600 in profit. You own the stock at $125 per share, but when you factor in the credit you've received so far, your cost basis is only $109 per share. So your cost basis is actually well below the current market value of the stock. So clearly in this situation, you fared much better than the stock investor. So let's take a look at another scenario. All right, so the same starting situation. We'll fast forward to 20 days where the stock goes to $135 a share. Now, the stock investor has a $500 profit. You, on the other hand, were able to close at a 50% profit for $400. We'll go forward another 20 days where the stock goes up another $5 per share, at which point the stock investor is now sitting with a $1,000 unrealized profit. The put seller is sitting with an $800 profit after closing out for another 50% profit. Let's go forward 20 more days where the stock goes up to $145 per share. Now the stock investor is sitting with a $1,500 unrealized profit, while you are sitting with a $1,200 profit after taking another 50% profit, but you get to sell another put for another $800 profit. So at first glance, it might look like the stock investor is outperforming you. But if you take a look at the total premium collected, you're currently sitting at $2,000. And at some point, this stock is going to either drift sideways or retract. And that's where you are going to see the advantage. And the reality is that stocks, again, they very rarely go straight up like this. And if they do, it's usually for a short period of time. And so let's look at one more scenario. The starting point is the same. The stock goes up to 132, just like in the first scenario. Then the stock drops to 130, just like in the first scenario. But after 60 days, the stock tanks and drops all the way down to $50 per share. So if we look at the stock investor's situation, the stock investor is now sitting at an unrealized loss of $8,000. He can either wait it out, wait for the stock to recover, but at this point his only other option is to sell the stock, in which case he's going to have to take an $8,000 loss. Now, we'll take a look at your situation. Again, you will have to buy the stock at $125 per share, and doing so will be painful. It's very difficult to have to buy something for much more than what it's worth, but at the same time, we have to keep things in perspective, because had you bought that stock, you would have bought at $130 a share. But you're only having to buy at $125 per share because that's the strike price that you sold. Plus, you've collected all of this premium along the way, and you get to keep 100% of the premium on the last put that you sold. So the total premium that you collected was $1,600. That brings your cost basis down to $109, which means your profit and loss is only $5,900. So that's a $2,100 difference between long stock strategy and the short put strategy. As you can see in all three scenarios, the put selling strategy is at least as profitable, if not more profitable, than just buying the stock. So the next question that you may be asking is, how do you know which strike to sell? Well, that just really comes down to how much do you want to own the stock versus collecting premium. So that means you have to go back to your overall goal or objective. But since the concept of this video is how to buy stock at a discount, I have to assume that you want to own the stock to participate in long-term appreciation. And so if we look at the options chain, we can have strike prices that are at the money, out of the money, further out of the money, in the money, and further in the money. The further out of the money the strike price, the less likely the stock will be in the money at expiration and less premium you can collect. So if you want to buy the stock as soon as possible, you can sell an at the money put, which will not only give you a higher chance of being put the stock at expiration, but it will also increase the amount of premium collected. But if you're not convinced that the stock is going to move up very quickly in the short term, and you don't mind collecting premium for a while as you wait to see what the stock is going to do, then going a little further out of the money can be a good strategy. At the end of the day, once you sell that put and collect that premium, it's yours to keep. It's the movement of the stock that's going to determine the overall profit and loss of the position, and if you have a high level of confidence in the stock, then you should be in good shape. So let's recap this strategy, step by step. Step number 1, identify the stock you want to own. Step number 2, identify your purchase price. Step 3, select an expiration with between 30 to 60 days to expiration. Step 4, sell the put with the strike price closest to your desired purchase price. Step 5, immediately enter a good to cancel order for a 50% profit. Step 6, if the order gets filled, go back to step 2 and repeat. Step 7, If the option goes into money at expiration, you will buy the stock at the strike price and you will keep 100% of the premium received. And once you own the stock, you can juice your returns even more by selling calls against your stock, which is what we call covered calls, which is part of the Wheel of Fortune strategy, which you can learn more about in this video, which is also linked in the description. And so that's it for today's video. Now you know how to use puts to buy stock at a discount, and at the very least, use them to generate consistent income. I hope you found it useful, and I hope it's something that you're able to benefit from in your trading portfolio. If you have any questions or comments, please put them in the comments section below. I'd love to hear from you. Are you currently trading options? Are you successful with the strategies? What is your favorite strategy? And are there certain things that you'd like to hear from me, certain strategies that you'd like me to cover? Anyway, that's it for today's video. Just remember that if you want to follow me on my trading journey, that I do release a portfolio performance update every week. So make sure you like and subscribe and hit that bell notification so that you can follow me on my journey. And for now, take care, and I look forward to bringing you more better options in the future. Bye-bye, everybody.